All right, class, so we're closing out part 3, the financial aspects of merchandising. Let's talk about inventory valuation. In retail, inventory is a driving force behind the success of the business. The ability to properly assess inventory is an important merchandising function that we'll explore. In preparing an income statement, one must be able to calculate the cost of goods sold. You can compute the cost of goods sold by taking the beginning of the fiscal period inventory that is on hand, adding in the value of the inventory purchased during that period, and then subtracting the end of the fiscal period inventory on hand. So on this slide, you can see the formula. Determining the value of inventory. Physical inventory is the most reliable way of conducting inventory. This method involves counting each item within the store. Typically, physical inventory is completed at a minimum of once per year. However, some retailers will conduct inventory semi-annually or twice a year. Perpetual inventory is a system in which physical inventory does not have to be conducted. Instead, inventory is determined by adjusting beginning inventory by purchases, sales, and price changes. This system allows inventory to be maintained on a continual basis. The figure that is obtained from perpetual inventory is called book inventory. Theoretically, book and physical inventories should always be equal. Balance is maintained by adjusting the book inventory accordingly by any changes in inventory status. New goods cause the book to be adjusted upward by the value of the goods received. When goods are sold, the book is adjusted downward by the value of the goods sold. The book can also be adjusted to account for returns and price changes. Overage and shortage. So, in reality, book and physical inventory rarely match, which results in discrepancies. Overages is when your physical inventory is more than your book inventory. Shortages is when your physical inventory is less than your book inventory. In retail, your shortages are generally referred to as shrink. So, how does discrepancies occur? It can be via external theft, which would be customers coming in and shoplifting. It could be internal theft, which is your staff stealing from the business. Or it could be clerical errors, which is also staff that may be putting information into the system incorrectly. Theft is the most common cause of shrink. For example, merchandise that is shoplifted remains on the book, but it is not physically in the store. Hence, the physical inventory is less than the book inventory. The two don't match. In layman's terms, your point of sale system shows you that you have 2 red sweaters, but physically you only have one. Clerical errors are made when staff inadvertently enters or scans in shipments incorrectly. For example, a retailer received a shipment of 100 shirts, but the employee misses a zero and enters 10. Here's another good example from the text. A vase is received into a gift shop's inventory and booked at $28 retail price. The item is ticketed at $28, but the 8 looks like a 6. So when the vase is sold, the sales is transacted at $26 rather than 28. The book inventory is adjusted downward by $26, resulting in an overstatement of $2, which will emerge as a $2 shortage at the next physical inventory. So shortages and overages are expressed as a percentage of net sales of the period between the current and the previous physical inventories. So you would take the shortage or the difference in dollars divided by your net sales and multiply that by 100 to get your shortage percentage. So let's do a little bit of problem solving. So here's the problem. Stephanie's boutique has a book inventory of $65,358. The store has a physical inventory of $57,851, and their net sales is $400,000. So again, remember your formula is going to be the shortage or the difference in dollars divided by your net sales multiplied by 100. So the difference is $7,507. So we're going to take that number and divide it by our net sales of $400,000. Then we're going to multiply by 100, which gets us to a shrink percentage of 1.9%. Physical inventory is generally conducted when a retailer is closed. So this can be done either after hours or the store may close early and conduct physical inventory. It's quite a tedious task that involves a lot of preparation, generally in the weeks leading up to physical inventory. That preparation includes pre-ticketing and organizing the inventory on hand. High shrinkage departments conduct inventory more frequently. Inventory reconciliation is when the results of the physical inventory are scrutinized to look at the discrepancies between the book and the physical inventory. Essentially, what you're doing here is you're trying to find a resolution. So, why is there a discrepancy? The fiscal impact of shortage. Inventory shortages and overages affect net profit because of their impact on the cost of goods sold. Shortages increase the cost of goods sold and reduce gross margin and net income. Overages decrease the cost of goods sold and increase gross margin and net income. Overages nor shortages are desirable. However, if there was one that was to occur, buyers would prefer overages rather than shortages because they positively impact gross margin and net income. So, shortage control. Buyers monitor the position and the value of inventory through reports of inventory position, price change, and receipts as a means to control shrinkage. They foster good inventory management through clear communication regarding ticketing of merchandise inventory counts, price changes, and returns to vendors. Your POS or point of sale system is a network of computerized cash registers that are linked to a central processing point, typically referred to as a back office. These systems process transactions. The product information that is obtained is transmitted to the back office. This information includes style, size, and vendor. The information is utilized to adjust book inventories and to compile inventory reports. These inventory reports are used to make decisions regarding product assortment, reordering, markdowns, and to balance inventory amongst stores. Higher volume stores have higher inventory levels. Merchandise from low volume stores may be transferred out into the high volume stores. The POS system also will track the productivity of salespeople. So it can track KPIs, so your key performance indicators, such as your sales in dollars over a period of time, the amount of units a salesperson is selling, the number of returns a salesperson is receiving, and more. It also tracks customer transactions. Last in, first out, LIFO, and first in, first out, FIFO. So last in, first out refers to goods that are acquired at the end of a fiscal period that are sold before the goods purchased earlier in the fiscal period. This particular method is used by 50% of major retailers. This is an accounting strategy that is used to improve cash flow through the deferral of income tax. LIFO retailers usually maintain two sets of inventory figures. One for external financial reports that reflects inventory using LIFO, and another for non-financial internal management reports using FIFO that more accurately reflects the actual movement of goods. So first in, first out. Goods are acquired at the beginning of a fiscal period, are then sold before goods purchased later in the fiscal period. So this closes up part 3, the financial aspects of merchandising.